Hi, I'm Ben Reppond. Welcome to my YouTube broadcast. Today is July 1, 2025. I want to begin with a couple of charts. These are Fed funds charts, give a context to what's going on with the Fed, which is, interest rates. Interest rates are, the Fed makes changes both up and down, and periodically, not all the time, but I thought I would start with a macro chart. This goes back to 2000, so this would give us about 25 and a half years of data, so you can see how the Fed has made decisions to raise rates and lower rates or hold rates. So this first chart shows that, and you can see from in 2000 where interest rates were raised, stabilized, and then dropped dramatically during 2001, 2002, and then in 2004, then they go back up, back down during the Great Financial Crisis, went to a bottom and stayed there for, I believe, about 8 years, and then raised again, dropped, and now raised. You can see at the very end, they've gone up quite a bit, which has accounted for, this is the Fed funds rate. So it does spill over into things like mortgages and consumer debt, things like that. Recently, it's pulled back. You can see that at the very far right of the chart. But this drives the economy. I mean, if they want to slow it down or speed it up, this is the mechanism they use to do that. Then I'm going to show you, just take the very end of that chart and show a little more micro. You can see really what's going on with starting with that flat period of about 8 years, and then interest rates were raised quite a bit, stabilized, and now they've been dropping. There is pressure right now, or commentary, I guess, people wanting to get the Fed to drop rates even further, and that is probably going to happen, but I won't speculate when. But that's the pattern. So you can see this does drive the economy. Okay, next I want to play a few videos. I got 4 of them. I just play you small clips from each one, showing the view of the market, what's going on with the market. Now, you know that during the month of March and early April, the market dropped about 20%. The reason for it is because of tariffs. Tariffs were announced. They came out of nowhere. No one was expecting it. One gets announced, and then another one gets announced. And so we don't know the implications of that. So because of the uncertainty, the market interpreted that negatively and dropped accordingly. Once things tended to stabilize, and I think people felt like, there's going to be counter tariffs, there's going to be negotiated adjustments, etc., then the market settled down. And the bottom of that decline was April 7th. From that point forward, the market took off. And so it has gone up quite a bit. It's gone up to, from the beginning of the year, it's now ahead about 5%, but it recovered all of that 20% loss, and then some. So it feels like that the market things are looking good, and the interpretation of whatever's out there of risk is not a big concern. But there are 2 views on that. So I want to play both sides of that, so you can see if you're an optimist and you believe that, the things are moving in the right direction and stabilized and moving up, and this is the time to be invested, etc. Okay, you'll hear some commentary on that. If you think there is more risk than ever, then you'll hear some commentary on that as well. Okay, so I'm going to begin with Stephanie Link is being interviewed by CNBC Becky Quick. Now, I've got this one. So this is Stephanie Link. This is followed by Stephanie Pomboy. So maybe I should have entitled video, the two Stephanies, I guess. But Stephanie Link provides kind of a positive view. So if you you look at the market as from a positive lens, she gives you reasons for that. The reason why it's stabilized and actually trending higher. And she had pulled, as an asset manager, she had pulled out some of her money from the market, only 9%. So she was 91% invested. Now she says that she is 99% invested, 1% in cash. So that's, obviously an optimistic view. So take a listen to Stephanie Link and Becky Quick.
All right, it's a holiday shortened trading week. Yay. And today is the last day of the second quarter. The S&P 500 and the NASDAQ both closing at record highs on Friday. So let's talk markets right now with Stephanie Link, the Chief Investment Strategist and Portfolio Manager at Hightower Advisors. She's also a CNBC contributor. Steph, we're looking at some pretty decent-sized gains in the futures this morning. The Dow's up by 225 points. Coming after all the gains that we've seen recently, and I think when I was reading through your notes, the thing that jumped out the most is you went from 9% cash in February to just 1% cash now, and if you could, you'd be buying more even at these levels?
Yeah, and it's great to see you, Becky. I think the message is that we are actually getting through a lot of the unknowns. Right. We were very worried in March and April, because we just didn't know what was going to happen with regards to tariffs and trade, geopolitics, inflation, the Fed, and we're sort of chipping away at all of those things. Now, we don't have answers on all of them, or any of them, actually, but we're starting to get more clarity. And I think that is why the markets are acting better. And as a result, I think we can focus on the economy. And the economy, we look at the Atlanta Fed tracker. Last week, it came in at about 2.9%. So you're running at about a 2.5% GDP in the first half of this year. That should lead to better than expected earnings. Earnings right now are expected to grow for the second quarter 5%. I think you're easily going to see double that. Easily. And that is because of the momentum that we're seeing in the economy. And the interesting thing is yields continue to go lower. We're actually at a 6-week low in terms of yields. That's good for equities. And you have $7 trillion of cash on the sidelines. That's all not going to come into the market, of course. But you do have a lot of people that are kind of taking this wait and see approach. And you can't do that. You actually have to buy ahead of the certainty. And that's what I was doing.
Okay, next, Adam Tagert is interviewing Stephanie Pomboy. She is a researcher, economist, sells her research to Wall Street firms, and she will give the other side of this. And she focuses on the consumer. She says the consumer is in trouble. The consumer is tapped out, borrowed as much as they can borrow. Interest rates are high, stubbornly high, and are not coming back down. People in this camp want interest rates to be reduced by the Fed, so to ease up some of that pressure, but the consumer is under pressure. The second thing she talks about is jobs. The job outlook is bleak. I think a comment was made, if you get an offer for a job, take it, because the job market is expected to become tighter. The job data is showing a weakening in that market. Then she goes on to home sales, and this is interesting. Home sales are down 13.7% from the previous year. And new listings are up 50%, which means that people are listing their homes, but they're not selling. So not a good picture. Okay, so I'll play this. Take a listen to Adam Tagert and Stephanie Pomboy.
How concerned are you about the future of the U.S. economy here? And I'll give one example. So Danielle DiMartino Booth, peer of ours, she has gone so far recently. She's been a real close tracker of the employment data, but also layoffs and things like that. And she's now really ringing a bell, saying, if if you're looking for a job, you better get it real quick, because jobs are evaporating fast, and she's expecting we're going to go into a big jobs drought. This isn't even including the AI threat, but just a sense of like, we're going to go into a real unemployment crisis going forward here, or at least high unemployment. Do you share that similar concerns, more or less?
Well, no, I think clearly the data have turned. I mean, look at the trend in the unemployment claims, which is really a very strong indicator and ties directly into the layoff announcements that she's looking at so closely. So you've seen a huge increase, a material increase in both continuing and initial claims. I would also underscore that, again, in yesterday's consumer confidence report, the component that really stands out as the worst is the outlook for employment. The jobs outlook is hideous. It's now the worst it was since COVID. So that suggests that consumer spending will follow, because if you overlay, real consumption with the jobs outlook, whether it actually materializes, which it generally does, consumers have a very good sense as to what the labor market is doing on the ground, and they tailor their spending accordingly. You would be talking about a real slowdown in spending on top of what we're already looking at. So I think that's important. The other thing that really has me worried and is crucial as relates to this sort of silent support to the economy from the wealth effect, and just in general, the economy itself, is housing and what's going on there. And we're clearly seeing real softening in the housing market. And, even in areas that are little bubbles, like the two places that I spend my life, which I would say are really bubble economies, what's happening is that listings, I actually had dinner with a friend of mine who's a real estate broker out here last night, and he was saying the number of listings has increased 50% in the last month. And while prices, exactly, they went, huge increase. But prices haven't yet come down, because things are just sitting. And this is a market where there's no urgency. There aren't distressed sellers who need to sell necessarily. So they're just sitting there. And the same, as relates to where I am out on the East Coast in Southern Florida, where that market, we were also seeing an increase in listings and things just sitting longer on the market. But when you go into sort of the real world, outside of these little highly, inflated bubble universes in which I seem to function, the situation on the ground is really looking pretty bad. You're seeing a huge increase in cancellations, and I think it was 1 in 7 or something housing contracts were just walked away from in April. I'm waiting to see the May numbers, which come out any day now. And that obviously the home builder survey last month, went back down to its COVID lows. You've seen a lot of weakness in the home sales data relative to what it should be doing this time of the year, which is seasonally when it really should be doing quite well. And this all comes back, of course, to what happens to interest rates. People are locked in because of the mortgage rate situation. And so, again, this becomes a question. If the Fed cuts, do mortgage rates go down? And if so, how much? And is it enough to really alleviate that? And if it is enough, does that actually lead to deflation in home prices? Because suddenly, people are able to move, so you get even more supply on the market. People have an ability to sell and relocate. So, all big questions, but there's a lot of uncertainty as relates to the biggest asset for most households out there, which certainly isn't going to be helping their confidence and, by extension, their spending, one presumes.
And then this next one, this is my third one, this will be Lance Roberts talking about why he believes the market is moving higher. And I'll put this in the category of probably an optimistic view.
You can see we broke above all-time highs, and are right now sitting above that resistance level. Money flows have turned positive as well, which is, also important because money flows were declining. You kind of see that very minor correction that we had, and it built a bull flag. You had this compression of price as we headed down towards support, and then on Monday we broke out of that tightening wedge pattern. That's what's called a bull flag, and we broke out of that. And money flows turned positive right out of that. So we saw a lot of money coming back into the markets over this last week. And really, it's chasing mostly AI stocks, stocks related to AI, and retail meme favorites. Those have been the big winners over the last week.
And finally, this is a podcast, or I guess a YouTube broadcast, by a company called Deep Value Investing. Now, I have not watched anything from them before. I thought this was an exceptionally well done video. And I'm going to play a clip from it, not the entire clip, but really good data. And they say it's I don't know who the people are. It's a man and a woman. They're going back and forth, and in a good way of presenting. And they're looking at three indicators, but I'm going to focus on two of them. The Buffett indicator, which is the market divided by the economy, that develops a ratio. And they point out that the Buffett indicator, which a lot of people follow, is in its 94th percentile. In other words, it is near its all-time high. And then the Shiller PE ratio, and developed by Professor Shiller from Yale, and I believe he won a Nobel Prize, and I think it was for this particular the Shiller ratio, and it's also coincidentally at the 94th percentile, near its all-time high. So both of these go up and down. And so the case would be made that things feel very positive right now. And that's why, the market has got optimism around it. But when you look at it from the standpoint of these indicators go up and down, when you're up at this level, although it doesn't feel like a lot of risk at this point, there is potentially quite a bit of risk when it comes down. Now, that may be right away. It may be later. It could be later this year. It could be next year. We don't know when. And it could also continue to go higher. But a lot of people look at this from a contrarian standpoint and think in terms of, okay, if it's that high, it pretty much has nowhere to go but down. That's not exactly correct, but that's not a bad way to look at it. Now, our approach to investing is we make shifts. We do not do buy and hold investing. I don't personally believe in that. I don't like taking that kind of ride down the elevator. So we make shifts. And so when there's risk that enters the market, we do something different. We become defensive. And if it's in our sector strategy, then we're shifting to defensive sectors. And then right after that, we'll shift to go completely out of the market and to money market funds if it continues down. And with our index strategy, that it shifts also to from more offensive type index like the NASDAQ, and goes over into the Dow, which is more value oriented, more defensive, and then also goes completely out of the market if bigger signs indicate that there's more risk ahead. So, but anyway, that's our approach to it. Everyone has got their approach. Some of them are active management. Some are, put bonds together with stocks in a passive approach. But whatever a person's approach is, if they are correct that this is nearing a high and that there is danger here, then it's going to call for investors to have a method to deal with that level of risk. So take a listen to this broadcast done by Deep Value Investing.
So, have you ever looked at the stock market recently and just felt like, well, like things are really booming.
Yeah, it certainly feels that way for many people right now, doesn't it? A lot of upward momentum.
It does. But is that the full, complete picture? You always wonder.
That's the key question.
Today, we're taking a deep dive into, the fascinating world of market valuation. We're peeling back the layers.
Looking at some of the big respected gauges out there.
Exactly. Our mission today is to dig into a stack of critical reports, some fresh insights on the famous Buffett indicator and the Shiller KPE.
And we're using data right up to Friday, June 27, 2025. So pretty current.
Very current. We'll pull out the most important nuggets, really, to help you understand what these numbers might truly mean for the future.
And that core question, are stock valuations stretched right now? And what does that actually mean for you, whether you're an active investor or, just someone trying to understand the economic landscape?
That's exactly what we're here to try and unravel.
Right. We're going to look beyond the sort of daily headlines and see what the historical data suggests, give you some context.
Okay, let's dive in. Let's unpack this with, well, what I sometimes think of as the market's ancient oracles, the two titans of valuation.
Good way to put it.
First up, the Buffett indicator. Now, this gauge, famously favored by Warren Buffett himself, it compares the total U.S. market cap to nominal GDP.
Right. The value of all stocks versus the size of the economy.
And as of June 27, 2025, it stood at approximately 206%.
206%. Wow.
Yeah. To give you a sense of scale, that means the total value of all U.S. stocks, roughly $61.6 trillion, is now more than double the size of our entire annual economy, which is around $30.0 billion.
Double the economy. That sounds big.
It is. And what's truly striking about that 206% is, well, where it sits historically. It places it at the 94th percentile.
94th percentile. So very, very high compared to history.
Extremely high. About 1.9 standard deviations above its 1970 to 2024 trend.
Yeah.
What does a reading like that usually signal?
Well, when the Buffett indicator has been this elevated historically, it typically signals extreme overvaluation. That's the common interpretation.
Okay, extreme overvaluation, but what's the implication?
And here's the crucial resection. So what? The real annual returns for the S&P 500 over the next 10 years, they've historically been less than 2%.
Less than 2% per year.
Per year. In real terms, after inflation. Think about that. For an entire decade, your equity investments might barely outpace inflation.
Oof. That really challenges the whole buy and hold mantra, doesn't it?
It certainly makes you think harder about valuations and future expectations. It makes every decision about where you put your money feel, well, critically important.
That's a powerful historical precedent for sure. Okay, next, let's turn to the Shiller KPE. That's the cyclically adjusted price-to-earnings ratio.
Right. Robert Shiller's metric uses 10 years of inflation-adjusted earnings.
And this indicator, also on June 27, 2025, stood at 37.65.
37.65. And much like the Buffett indicator, the Shiller KPE is also way up there, also the 94th percentile historically.
Same percentile. That's uncanny.
It is quite striking. And to give you some maybe chilling context, only two periods in history have seen higher KP readings.
Which were?
1929, right before the Great Depression.
Oh, boy.
And the infamous 1998-2001 dot-com bubble.
Not exactly comforting comparisons.
Not at all. And this current reading, it implies a 10-year real return of maybe about 2% to 3%.
So again, very low single digits.
Very similar. Both these major gauges are pointing in a very similar, very cautionary direction right now.
It's really striking how aligned they are, these two distinct indicators. When you see such a strong overlap, both flashing expensive, what does that really tell you? More than just one indicator alone.
Well, I think it tells you that the market's exuberance, or perhaps its pricing, is broad and deep. It's not just one aspect that looks stretched.
Okay.
You see, the Buffett indicator measures market value against the size of the economy using nominal GDP.
Right. Stocks versus GDP.
Its takeaway now is that stocks are priced at about 2 times the size of the economy. A level, as we said, eerily similar to dot-com extremes. The Shiller KP, though, measures price against 10-year earnings power, adjusted for inflation.
Price versus long-term earnings.
Exactly. Its current takeaway is that these earnings multiples are back at late 1990s highs, even though EPS growth seems to be generally slowing down.
Okay, thank you for watching. If you have questions or comments, leave them in the comment section below.